So hi there, my name is Mr. John Mark. I'll be taking you through advanced financial reporting, and today I want us to cover a topic called employee benefits. That's under IAS 19. And employee benefits are all forms of consideration given by an entity to an employee for the services rendered to that organization by the employee. So such as we can see salaries, commission, allowances, per diem, etc. Those are what we call employee benefits. And IAS 19, employee benefits are classified into various classes. So now let's look at type of employee benefits. And one, we have what we call number one, short-term employee benefits. Number two, we have what we call termination benefits. And number three, we have what we call retirement or post-employment benefits. So those are the major three types of employee benefits. I start with number one. Number one is what we call the short-term employee benefits. Short-term employee benefits. And short-term employee benefits, they are benefits payable to an employee within a duration of 1 year or within 12 months, such as e.g. salaries, wages, commission, bonuses, etc. Those are what we call the short-term employee benefits. Then we have termination benefits. Now, termination benefits, they are benefits payable to an employee upon work being terminated by either the employee or the employer. So that's what we call termination benefits. They are benefits payable upon work being terminated by either the employee or the employer. And then we have number three, what we call post-employment benefits or retirement benefits or the pension. And the post-employment benefits, they are benefits payable to employee upon retirement. And that's why they are called retirement benefits or the pensions. So, and that's what I want us to focus on. I want us to focus more on employee, on post-employment benefits under this topic. And we have said that they are benefits payable upon retirement. And we have two types of retirement benefits, or we have two types of pension plan. So we look at types of pension plans. One, we have what we call defined contribution plan. And number two, we have defined benefit plan. So those are the two types of pension plans we have. And number one, we have the defined contribution plan. Now, under the defined contribution plan, the benefit payable upon retirement will be based upon on the amount of contribution made by both the employee and the employer to that scheme. So we are saying that under defined contribution plan, the amount payable upon retirement will be based upon on the amount paid by both employee and employer during their career life. So in this case, we also say that in this case, the employee bears the uncertainty of the amount receivable, will bear the uncertainty. Now, for example, assuming you as an employee, the amount contributed to that pension during your career life was 3 million. That's what was contributed by both the employee and the employer. So in your account, we contributed 3 million. Now, upon retirement, the amount receivable is said that it will be based on the amount you contributed. But we are saying that the employee will bear the uncertainty of the amount receivable. That means upon retirement, if you contributed 3 million, will you get 3 million? Will you get 3 million? So you will not get 3 million. You will get 3 million plus. Why? Because what they usually do as the pension plans, the amount you contribute there, they usually do reinvest this amount. And when they invest the amount they get, or as a profit of the returns, they need to share with you because remember they invested using your money. So in this case, you have 3 million plus some returns or profits. And these profits will be based upon on how the investment was performing. If the investment was performing better, the higher amount you will get. So in that case, we are saying that the employee bears the uncertainty of the amount receivable, which will be based on the amount, on the performance of the investment. Then we have defined benefit plan. Now, under defined benefit plan, the amount payable upon retirement will be based upon on either the final salary or the average salary during the career life. So the amount payable will be based either upon on the final salary or the average salary, but this computation will be based on what we call the actuarial assumptions. Actuarial assumption, we mean that, for example, they might decide that they take 2/3 of your average annual salary, and then they multiply by the number of years of service. So take the average salary times the year of service. Now, this is what we're saying, that this calculation will be based on what we call actuarial assumptions. And for actuarial assumption, we have what we call the financial assumptions. Those are the factors to consider. And for financial assumptions, they may look at things to do with inflation rate, required rate of return, interest rate, etc. And then another actuarial assumption they need to consider is what we call demographic assumptions. And for the demographic assumption, the assumption which include to the rate at which maybe they look at the mortality rate, the claim rate under the medical plan, things to do with that. Also the labor turnover, etc. So they will be based mostly on the financial assumption and the demographic assumption. And those are the two types of pension plan: defined contribution and defined benefit. Where defined contribution, the amount of the pension received upon retirement will be based upon on the amount contributed during the career life. But defined benefit plan, the amount payable upon retirement will be based upon either on the final salary or the average salary, but the computation will be based on the actuarial assumptions. Good. So now let's look at measuring defined asset and liability. How do we measure asset and liability? So measuring defined plan asset and liabilities. So in this case, the amount of starting at the beginning of the year and the amount at the end of the year, they will be reconciled to determine whether there was an actuarial gain or whether there was an actuarial loss. That's what we call reconciliation. So you're saying that the amount at the beginning and the amount at the end will be reconciled to determine the changes. So let's start with how do we measuring defined plan asset. So we start with defined plan asset. How do we measure this? And this is how we measure the defined plan asset. The format is very important. You take the fair value of plan asset, balance brought down. Then you add contribution to the plan, and then you also add return on asset, return on plan asset, you add it, and then you deduct the amount of benefits paid, So what you get there, we can call it the carrying amount. Now you compare the carrying amount against, it will be given the fair value of plan asset, balance carried down. The market at the value at the end of the year will be given that. So now the difference between the carrying amount and the fair value balance carried down, that change is what we call actuarial changes. Now actuarial changes, it can either be an actuarial gain or actuarial loss. So it can either be an actuarial gain or actuarial loss. And how to determine the gain or loss? If the asset increases or when the asset increases, that's what we call an actuarial gain. But when the asset decreases, we say it's an actuarial loss. Then number two, that's number one. Number two, defined plan liability. So how do we measure defined plan liability? And this is how we measure. You take present value of obligation or liability, balance brought down. Then you add, remember liability gives rise to expenses. You add expenses, one being the current service cost. Then we have past service cost and also the interest cost. You add those three classes of expenses: current service cost, past service cost, and the interest cost. And then you deduct the amount of benefits paid. There's the amount of benefit paid. Then you get your carrying amount. And then you compare your carrying amount against the present value of obligation, balance carried down. You'll be provided with that. And now, the difference between the carrying amount and the present value balance at the end, it's also what we call actuarial changes. Actuarial changes. It can also be actuarial gain or actuarial loss. They are also known as measurement gain or measurement losses. So that's basically the format on how to measure defined plan asset and defined plan liability. So now with that, I want us to look at an illustration from the past paper. You can take out your past paper. We do an illustration. And let's start with September 2015. September 2015, question 4A. September 2015, question 4A. So let me read the question. And we are told that. So first of all, when you're measuring the defined plan liability or assets, the format does not change. So you can first of all even write the format, and then you'll be inserting the values because it does not change. And we are told that Volta Limited operates a defined retirement benefit plan for its employees. On 1st January 2014, the fair value of the pension plan asset was 2.6 and the present value of plan liability was 2.9. So let's fill that. We are told that on 1st January, the fair value of the pension plan asset was 2.6. So the fair value of plan asset balance brought down, you are given was 2.6. And the present value of plan liability was 2.9. The present value of obligation balance brought down was 2.9. Then you are told that the second paragraph, the actuary estimated that the current and the past service cost for the year ended that 1st December 2014 at 450 and 90 respectively. Estimate the current service cost at 450 and the past service cost at 90. Remember, I said that to the defined liability, you take the present value of obligation, you add the current service cost and the past service cost. Then I told that the past service cost is caused by the improvement in pension benefit commencing on that 1st December 2014. The pension plan paid 240 on that 1st December 2014. The pension plan paid 240. Now that 240 is what we call benefits paid. And we say that for the benefits paid, you deduct from both, that was 240, from both assets and well as to the liability. You see, we said you deduct less benefit paid, and benefit paid was 240. You deduct that. So the pension plan paid 240 on that 1st December 2014, and on the same date, Volta Limited paid 730 in contribution to the plan. Volta paid 730 to contribution to the plan. So we say that under the assets, you add contribution to the plan, and there was an amount of 730. Then, interest rate on high quality corporate bond for the year was 8%. The interest rate was 8%. So how do we use the interest rate? So now, return on plan asset, you'll take 8%. If you invest, you'll get an interest of 8%. So you take 8% of the balance brought down. So how much was the balance brought down? For the asset, the balance brought down was 2.6. Then, so how much is that? You get it's an amount of 208. The same for the liability. For the liability, we have the interest cost. For interest cost, you take 8% of the obligation balance brought down, which was 2,900. And what do we have there? So in that case, we'll have an amount of 232. We continue. Then you are told that as at the year end, fair value of pension plan asset was 3.4 as at the year end. So that's the fair value of plan asset. So the value was 3.4. And present value of plan liability was 3.5. The present value of liability was 4.5. Was 3.5. Like that. Now, in accordance with year 2011, revision of IAS 19 employee benefits, Volta Limited recognizes measurement gain and losses in the comprehensive income, in other comprehensive income for the period they occur. I remember those measurement gains and losses is what we call actuarial gains and losses. Required. Calculate the measurement gain or losses on pension plan asset and liability that will be included in the comprehensive income for the year ended that 1st December 2014. So let's compute that measurement gain and losses. So we start with the assets. For the assets, you take the fair value, you add contribution to the plan, you add return on plan asset, you deduct benefits paid for you to get the carrying amount. So how much will you get? So it's 2,600 plus 730 plus 208 minus 240. Find a value of that 298. Then, the difference between, now you compare the carrying amount and the balance carried down. The carrying amount was that 298, but the balance at the end is 34. So what has happened? So there was an increment from that 298 to 3,400. There was an increment by an amount of 102. So what is that 102? Now that's what we call an actuarial gain. That's what we call actuarial gain because it was an increase. Let's go to the liability. The liability, you take the present value of obligation, that's 2,900. You add current service cost, you add service cost, past service cost, and the interest cost. Then you deduct the benefits paid. So to get our carrying amount. So how much will be our carrying amount? Our carrying amount will be 34,32. Now that's our carrying amount. Now you compare your carrying amount against the balance at the end. So from 34,32 to 3,500, there was an increment. And there was an increase by an amount of 68. An increase by 68. So what is that? That's what you call actuarial. Have you answered yourself? That's what we call actuarial. There was an increase. So that's what we call an actuarial loss. Remember, when a liability increases, it's not like an asset. When an asset increases, it's a gain. But when a liability increases, it's a loss. So that means how much will be our net actuarial? Our net actuarial changes. You see, from the asset, we had an actuarial gain of 102. Then we have an actuarial loss of 68. Now, the difference between the two, which is 30, that's 30, yeah? Yeah, which is that, yeah? The difference between the two, this is what now you'll take it to other comprehensive income. The difference between the two, sorry, this should be that 4, not that, yeah? The difference between the two, you take it to the other comprehensive incomes. And I'll show you where we present other comprehensive income. So you may look at that. Then we try another question still from the past paper. So let's do another illustration from the past paper. Open with me December 2012, question 4B. December 2012, question 4B. And 4B, you are told that. Viwanda Industry Limited operates a defined benefit post-employment plan for its employees. The plan is reviewed annually, and the company actuaries have provided the following information. So you are given the information there. So I want us to read the information and then we key in. The format does not change. So that's why I have maintained the format. First, we are told that present value of obligation, remember it's a liability, as at that 1st October 2011 was 1500. So that is present value of obligation balance brought down was 1500, and our figures are in millions. Then you are given that present value of obligation as at that 1st October 2012. Now that's the balance carried down. As at that 1st October 2012 was 1750. Yeah, 1750, like that. Then you are told that, number 3, the fair value of planned asset as at that 1st October 2011 was 1500. The fair value of planned asset balance brought down was given an amount of 1500. Then fair value of planned asset as at that 1st October 2012 is 1650. That for the asset, the fair value at the end, the balance carried down, you are given as 1650. Then we have current service cost, 160. Our current service cost is 160. Then contribution paid, 85. Contribution to the plan was 85. Benefits paid to employees, 125. We say that we deduct benefits paid. Benefits paid, you deduct 125. Also from the liability, benefits paid was 125. Then we have net cumulative unrecognized gain as at 1st November 2011. That one not reported to this format. Additional information. Number 1, the expected return on planned asset on 1st November 2011 was 12%. The expected return on planned asset was 12%. So that means return on planned asset, you'll take 12% of the balance brought down. At the beginning, we have invested 1500. So 12% of that is an amount of 180. Number two, the discount rate for planned liabilities as at 1st November 2011 was 10%. Yeah, the discount on planned liability. So that will give rise to interest cost. So interest cost, you take 10% of the balance brought down, and the balance brought down was an amount of 1500. In that case, you have it's 150. We had no past service cost. Then number 3, the average remaining working life of Viwanda Industry Limited employee as at that 1st October 2011 was 10 years. So now first of all, let's determine our actuarial changes. Let's determine the actuarial changes. How do we determine our actuarial changes? First of all, let's get the carrying amount for the asset. By taking 1500, you add contribution of 85, you add return of 180, but you deduct the benefits paid of 125. And we'll have 1640. Then, the carrying amount is 1640, but the balance carried down is 1650. So there was an increment by 10. So that 10 is what we call actuarial gain. So that's an actuarial gain. Let's do the same for the liability. For the liability, it's 1500 plus 160 plus 150. Then we deduct the benefits paid of 125. To have our carrying amount will be 1685. 1685. Now, then you compare the carrying amount against the balance carried down. From 1685 to 1750, there is an increment. There is an increment by 65. Now, this increment in liability, you see that increase in liability, that one is an actuarial loss. So we have, if we want to determine your net actuarial changes, net actuarial changes. From asset, we had a gain of 10. But minus, we had an actuarial loss of 65. So we have a net of 55. In short, we have a net actuarial loss of 55. Good. So now let's go to the required. Required. What was the question? The required extract of Viwanda Industry Limited financial statement for the year ended that 1st December 2012. 14 marks. You get 14 marks. Viwanda Industry extract of financial statement. This is what was not required. They want financial statement extract. This one is not a financial statement. This will go to the notes of the financial statement. So when they ask about extract of the financial statement, what do we the examiner want to determine? Do you know what do we take to the income statement? Do you know what to take to the statement of financial position? So now let's present that. Number one, we start with the income statement. So Viwanda Industries income statement extract for the year ended when was the year ending? That 1st October 2012. That 1st October 2012. So to the income statement, what do we have? So we start with the income. You only get an income from an asset. So now let's go back here. So here under the defined plan asset, we had return on plan asset. And we had a return of 180. So that's what you bring here. So return on plan assets, that's the only income, 180. Then to the expenses. Expenses arise from liabilities. So now let's be here. Under liabilities, we have three expenses. We have current service cost, past service cost, and the interest cost. So that's what you show here. So under the expenses, you show the current service cost, past service cost, and the interest cost. So under our current service cost, we had was an amount of 160. And then past service cost was an amount, we didn't have that, and the interest was 150. So now if you take the income minus the expenses, what you get there is what we call net pension cost. That's how we determine net pension cost. If you take 180 minus 160 minus 150, you get net pension cost of 130. It's not a must you have to show it as a negative, provided you have said it's a net pension cost. Then, there down you show other comprehensive income. When presenting the income statement, other comprehensive income goes immediately after the net profit or after profit after tax. And for other comprehensive income, that's when you show your actuarial changes. And we had an actuarial changes net of 55. Remember, we had an actuarial gain of 10, and then we have an actuarial loss from the liability of 65. So we had a net of 55, like that. Yeah. So, and that's how you show an extract of the income statement. Then let's show statement of financial position. Show statement of financial extract. How do we show that? To the statement of financial position, what do we take there? So, number one, we start with non-current assets. And under non-current assets, this is where you bring defined plan assets. And you bring the balance carried down. So let's be here. So under defined plan asset, we had the fair value of plan asset balance carried down. That's at the end of the year. The amount was 1650. That's what you show there. So the defined plan asset, amount will be 1650. Then we go to the other part, equity and liability. And under equity and liability, under the equity, we have the equity reserve. That's the actuarial changes. So we bring actuarial changes. That's part of reserve. It's an equity reserve. An amount of 55, which is a negative. And then to the non-current liabilities, you have defined plan liability. And you bring the balance carried down, which was 1750. So let's be here. So under the defined plan liability, we had present value balance carried down of 1750. Now this is what you take it to the statement of financial position as your non-current liability. Or you can do this. Instead of presenting the non-current asset and non-current liability, you may decide which is more. Between asset and liability, which is more. In this case, our asset was 1650. That was asset 1650. But our liability was 1750. You see, this is the asset to assets, total liability. So, and that means we have more liability than the asset. The difference is 100. So now this is what we call the net liability. If the asset was more, you could have presented as net asset. So net liability is when the liability are more than the asset. And when we have the net asset, it's when the asset are more than the liability. And that's how you show the extract of the financial statement. So you may look at that. So let's do another illustration from the past paper. Open with me December 2017 question 2C. December 2017 question 2C. December 2017 question 2C. You can open that as I write the format. And we say that. How do we write the format? So I've decided to lab it. So under defined plan asset, we said you start with the fair value balance brought down. That's for the asset. And then you add contribution to the plan. Also you add returns on plan asset. And then you deduct the amount of benefits paid. What you get there is your carrying amount. And then you compare your carrying amount against the fair value balance carried down. So now let's go to the liability. Defined plan liability. And at a defined plan liability, we say that you take present value of obligation balance brought down, and then you add expenses, one being the current service cost, past service cost, and the interest cost. Then you deduct the amount of benefits paid. And that's how you determine your carrying amount. Then you compare your carrying amount against the present value of obligation balance carried down. So now let's open that question, December 2017 question 2C, hoping we are there. But see, you are told that the following information was extracted from the book of Comfort Retirement Benefit Scheme for the year ended that 1st October 2016 and that 1st October 2017. So we have 2 years. We have 2016 and we have 2017. So in this case, we'll be presenting for 2 years. 2016, 2017. 2016, 2017. So we have the discount rate on 1st November. Expected rate of return on plan asset, average remaining service life in years. Then you have fair value of plan asset, 1st November. So what does that mean? Is it balance brought down? Is it balance carried down? You see, in this case, we are told the year ends, we have 2 years, 2016 and 2017. And the year ends on October. So what you're given there, the fair value of plan asset as at 1st November. For example, the one for 2016, that's the end of 2016. So for the plan asset, you're given, that's the balance carried down. Fair value of plan asset 1st November, we have 96. That's 2016. And 2017 we have it's 110. Then we have the present value of plan obligation, 1st November. That's at the end of, that's the balance carried down. And here we have 100 and 125. 100 and 125. Then we have the current service cost. Current service cost. So current service cost, 2016 we have it's 8 and the other one is 10. Then we have benefits paid, 15, 12. We said benefit paid, 15 you deduct and 12 you deduct from both the liability and from the asset. From the asset we had benefits paid. For 2016 it's 15 and the other one is 12. Then we also have contribution to the scheme. We say that for the contribution you add the part of the asset and contribution to the, we have 9 and 11. And then we have past service cost. For the past service cost, that's the liability. We had 4 and dash. Additional information. Number 1. As at 1st November 2015. Now remember, 1st November 2015, that was the beginning of the financial year of 2015-2016. So that means you're already given the balance brought down as at 2016. So as at 1st November 2015, the present value of plan obligation and fair value of plan asset were both 100. So that means the balance brought down for our asset was 100 and also for the liability was 100. We have to do that for both, they were 100 million. Assume all the transaction accrued at the year end. So now with that, now let me give you something. You see in this case, we don't have the balance brought down for 2017, but note that the balance carried down for 2016 will be opening balance for 2017. So this 96 will be our opening for 2017 as well as for the liability. For the liability, the balance carried down for 2016 will be our opening balance for 2017, which is 100. And then we are told that we go back there up. Discount rate on 1st November. We are given the discount rate. For 2016, now discount rate will give us the interest cost. For 2016 was 10%. So you'll take 10%. To get for 2016, you take 10% of the balance brought down, which is 100, and you'll have 10. And then for 2017 was 8%. You take 8%, that's for 2017, 8%, and the opening balance was still 100. Like that. So there you have 8. That's how you get the interest. And then you also told that the expected rate of return on plan asset. On plan asset, that's the return on plan asset. In 2016 was 12%. And for 2017 was 10%. Like that. So that means for 2016 you take 12% of 100, which is 12. For 2017, you take 10% of 96, which is 9.6. So that's how you get the return on plan asset. So with that, now we can be able to get our carrying amount. We get our carrying amount. So 100 plus 9 plus 12 minus 15. So there you have is an amount of 106. And here you have an amount of 104.6. Then you compare. The carrying amount for 2016 was 106, but at the end it's 96. So you see there is a reduction by 10. That 10, so we can call them actuarial changes. For the asset, there was a reduction by 10, so that one is an actuarial loss. We go here to 2017. The carrying amount was 104.6, and the balance carried down is 110. So there is an increment by 5.4. That's 5.4. It's an increase from 104 to 110. So this 5.4 is what we call actuarial gain. Now let's go to the liability. First of all, you get the carrying amount. 100 plus 8 plus 4 plus 10 minus 15. And you have it 107. And for 2017 will be 106. And then you compare the carrying amount against the balance carried down from 107 to 100. So actuarial changes So here we have a change of 7. Is it a gain? Is it a loss? Now this is an actual gain because liability have reduced from 107 to 100. 2017 from 106 to 125. So there is an increment by 19. That's an actual loss. An increment in liability becomes an expense. So that one is a loss. So what does that mean? So let's go to the required. Let's go to the required. Required number one. The actuarial gains or losses. So the actuarial gain or losses, we already have them. So we are through with number one. Number two, the net pension cost to be charged to the income statement, 4 marks. The net pension cost to be charged to the income statement. We said that, how do we get the net pension cost? To get the net pension cost, so number two, we are getting the net pension cost. We have here 2016 and 2017. This is what you do. To the income statement, we said the income is their return. Return on plan asset. And return on plan asset, here we had was 12, and this was 9.6. Then you raise expenses. Under expenses, we have current service cost, past service cost, and the interest cost, like that. So how much was the current service cost? The current service cost here for 2016 was 8, and there 2017 was 10. Past service cost we had 4, there we had dash, and interest we had 10, and here we had 8, like that. That's how we get our net pension cost. 12 minus that, so here you have 10. It's not a must you have to show them as a negative since you are shown is a cost. And there we have what? For 2017, we'll be having 8.4. So those are the net pension costs to be taken to the income statement. And then number three, balances to be reflected to the statement of financial position. What do you to show to the statement of financial position? To the statement of financial position, a statement of financial position, what do you show? So we have here 2016 and 2017. So to the assets, to the non-current asset, we have defined plan asset. And for the defined plan asset, let's be here. For the asset, you bring the balance carried down. For 2016 was 96 and 2017 was 110. So 96, 110. Then to the equity and liability, equity and liabilities. Under the equities, we say that we have a reserve, and that reserve is the actuarial changes reserve. Actuarial changes. This is how we get the actuarial changes. So let's be here. Let's be here. So we had an actuarial changes for 2016. We had this loss. You see, it's a negative, this loss, and then from the liability we had a gain. So a loss of 10, a gain of 7. So in short, how much would be the net? So you'll be having a net of 3, which is a loss. So you'll have 3 like that. Then in year 2017, we had an actuarial gain. This is 5.4, which is positive. It's a gain, but we had an actuarial loss from the liability. So 5.4 minus 19. So, and what do we have there? We'll be having 13.6, which is an actuarial loss. You show them like that. And lastly, we have a non-current liability. We had defined plan liability. Defined plan liability. And for defined plan liability, you just show the balance carried down. For the defined plan liability, the balance carried down, we had 100 and 125. So 100 and 125. You just show that. It's just an extract. Should not balance because you are showing an extract. So look at that. And then at your free time, you can try June 2011, question number 3B. So now let's look at accounting and reporting by pension plans. So how do the pension plan present their financial statement? And measuring the two financial statements. Number one, the income statement, they call it statement of changes in net asset. That's the income statement. And the statement of financial position, they call it statement of net asset. So those are the two major accounts they usually do prepare. The statement of the net changes in net asset, that's the income statement, and then statement of net asset. And this is the format. This is the format. That's how they present. For the statement of changes in net asset, we start with the incomes. To the income, their major sources of income. Remember their pension plans. Their major income is the contribution made by both the employee or the employer, then maybe transfer from other scheme, and then investment income. If they invest, the amount of return they get is still their income. But their major source of income is the contribution by both the employee and the employer. Then, on the side of the expenses, their major source of expense is the pension benefits, the pension and other benefits paid to employees. So, we have pension and other benefits, lump sum benefits, transfer to other schemes. Transfer to other schemes. Then we may have general operating expenses. And then what they get there, it's either a surplus or a deficit. So that's how they present the statement of changes in net asset. Now let's go to the statement of net asset. How do they present the statement of net asset? This is the same as the statement of financial position. So you start with the non-current assets. You just, that one nothing changes. We show PPE investment, where they invest. If they purchase shares, bond, debentures, they are part of non-current assets. Then under current assets, we have cash and bank balances, contribution due. Now, contribution due, remember I said that contribution is their major source of income. We have some contribution which they have not yet received. So, you add it there as part of current assets. And then we have the current liabilities. You deduct current liabilities. We have payable and paid benefits. So, in this case, you take non-current assets, you add the current assets, and then you deduct the current liabilities for you to get the net assets. And then you say financed by accumulated fund. Now, the accumulated fund is equivalent to the capital or the equity. So they don't term their capital or the equity, they term it as accumulated fund or accumulated surplus. And then you add the surplus, the one you got from the income statement, and then you add any other reserve. So that's how they present statement of net assets. Statement of net asset. So we may look at that. Now with that, we can do an illustration. So I have provided an illustration in your handout. So from the notes, kindly follow that illustration I've given there. And I just want to read the question, and then you follow the workings there. And the question goes like this. So hoping you have your handout with you. The question is there. So the following trial balance was extracted from the account records of K Retirement Benefit Scheme for the year ended 30th October 2016. So we have accumulated fund as at 1st October 2015. We have said that accumulated fund, that's their capital. Accrued expenses. Accrued expenses is not an expense. It's a liability. It's a current liability. It's an expense we have incurred but we have not yet paid. Then we have admin expenses. It's an expense. Cash and demand deposit. That's part of current assets. Loss of value of investment. Loss of value of investment, that's more of depreciation, so it's an expense. Lump sum retirement benefits. We say that all lump sum benefits paid their expenses to the company. Then, contribution due within that days. Contribution due within. So that's the contribution we expect to receive within that days. So that's part of current assets. Employer's normal contribution, that's an income. Individual transfer in from other scheme, it's an income. Individual transfer to other scheme, it's an expense. Investment income is an income. Immovable properties, that's part of non-current assets. Immovable property, they are things to do with land and buildings. Then we have Kenyan government securities. That's an asset, it's a non-current asset. That means they invested in the government security. Then we have members' normal contribution. That's an income. Members' additional voluntary contribution is still an income. Pension, we say they are the expenses. Yeah, they are their major source of expense. Then we have equity investment. We have quoted equity investment. Now, all the investment, they are part of assets. And then we have unpaid benefits. Unpaid benefits, that's a current liability. And lastly, we have unquoted equity investment. So still, it's an asset. We said all investment are assets. The difference between the quoted and unquoted equity investment is that quoted equity investment, we invested in shares of a public company, but unquoted equity investment, we invested in shares of a private company. Then required, number A is a statement of changes in net asset, and number B is a statement of net asset. So I have already provided the solution, and I have already told you what are the assets, what are the liability, what are the income, what are the expenses. You just follow the solution I have presented there. So thank you for your time, and that's the end of that session. Thank you.